Another question we get a lot during tax season takes place when a client sells their house in the previous tax year and they come in and they want to make sure they don't have to pay any capital gains taxes on that sale. And the truth is, most Americans don't have to pay any capital gains taxes on the sale of their houses, as long as they're considered to be your personal residence. Now, personal residence is a house that you lived in for 2 of the last 5 years before you sold the home. Those 2 years don't have to be consecutive, but you do have to be living in that house 24 months of the last 5 years before you sell it. If you do, there's some exclusions. If you're a single taxpayer and your profits are less than $250,000, you do not have to pay any taxes to the federal government. If you're married, that number doubles. If you make a profit less than $500,000, you do not owe any taxes to the IRS. Now keep in mind what we talked about in the last video. We said that you cannot deduct year-to-year capital improvements or deductions on your personal residences, but here's where they come in to help. If you're close to that profit margin where you might have to pay taxes, remember there's a few things that you can add to the cost basis to reduce the profit. Realtor fees, if there's a realtor commission, you can make sure you write that off, add it back to the cost basis. Any closing costs with lawyers, that you could add that back into the cost basis as well. And most importantly, and what most people have, are the capital improvements. If you did put that kitchen in, you did put that bathroom in, you did put that roof on, that minimizes the profit. So be sure when you come in to bring all that information with you, any of the closing forms, that's all helpful. But to answer the question, most people do not have to pay any capital gains taxes on the sale of their personal homes. Thank you and enjoy the weekend.